Hey everyone, welcome to today's Explainer. We're diving right into the role of money market in India. It's kind of like this invisible ecosystem, right? But honestly, it's the absolute lifeblood of daily business operations. It's fast, it's massive, and it literally keeps the entire economy's wheels turning. Okay, so let's quickly run through our agenda. We're going to track this capital flow across 5 main pillars today. First, defining the money market. Second, managing short-term liquidity. Third, the equilibrating mechanism. Fourth, fueling commerce and industry. And finally, number 5, the RBI and monetary policy.
All right, starting off with Section 1, defining the money market, or as we like to call it, the market for near money. So what exactly is it? Well, the money market is a highly liquid wholesale ecosystem, and it's designed specifically for lending and borrowing short-term funds. The absolutely critical boundary you got to remember here is the maturity period. It is 1 year or less. The second a loan goes beyond 365 days, boom, it legally crosses over into the capital market. But inside that strict 1-year window, we're dealing with what's known as near money. These are highly liquid, incredibly fast-moving instruments that generally carry a much lower risk.
And the actual tools used in this ecosystem, well, they aren't stacks of physical cash. We're talking about digital instruments transacting trillions of rupees daily. The scale is just staggering. You've got call money for overnight interbank borrowing, treasury bills issued by the RBI to patch up temporary government shortfalls, and commercial papers, which basically act as unsecured promissory notes for major corporations. They function as instant substitutes for cash, so these massive institutions can trade immense value without a single physical rupee actually changing hands. Pretty wild, right?
Moving right along to Section 2, managing short-term liquidity. This is the dynamic safety valve.
Now, I want you to imagine you're running a major commercial bank. Let's say on Tuesday, you've got this massive surplus of cash just sitting there idle, earning absolutely nothing. But then, fast forward to Wednesday afternoon, and you're facing a sudden severe shortage because of some unexpected corporate withdrawals. Well, the money market acts as an instant release valve for this exact kind of volatility. You can instantly deploy that surplus cash overnight to earn interest, or on the flip side, seamlessly borrow emergency funds to maintain your strictly mandated daily liquidity requirements.
Exactly. And when you scale that safety valve up to a national level, it creates this incredible bedrock of stability. Monetary authorities get precise management over the total liquidity coursing through the economy. Because these instruments are such reliable substitutes, it heavily economizes the use of actual cash. Crucially, it guarantees businesses reasonable access to short-term funds at realistic, market-driven prices. And for institutional investors, it allows for slick, agile portfolio management. They can balance varied assets to minimize risk while still capturing those short-term returns. It's literally the daily hum that keeps the broader economy stable. Which brings us to Section 3. The equilibrating mechanism, or basically balancing the scale.
So think of the money market as a giant, hyper-efficient scale. Over on one side, you have entities with short-term savings, surplus funds they don't immediately need. Then on the other side, you've got entities facing urgent, short-term deficits. The money market steps in to allocate these scarce, short-term resources completely rationally. By continually matching lenders and borrowers in real time, it establishes a perfect equilibrium between the immediate demand for loanable funds and the available supply. Capital never just sits unproductively, it actively hunts for where it's needed most.
Next up, Section 4, fueling commerce and industry, and really driving industrial growth. Let's actually track an entire commercial supply chain to see this in action, because it's fascinating. Step 1, a factory needs working capital today to buy raw materials to fulfill a massive order tomorrow. Step 2, a wholesaler has to aggressively manage and store that inventory before it ever hits the retail shelves. And Step 3, local and international traders need to secure trade bills, basically promises of payment, just to keep goods shipping globally. If any of these links are starved of short-term cash, the whole supply chain just grinds to a halt. Instant access to money market funds is what prevents a total system failure.
Yeah, this market is essentially water for economic growth. It provides critical working capital not just for the massive corporations, but for agriculture and small-scale industries alike. By facilitating the rapid discounting of bills of exchange, it unlocks cash that would normally just be tied up in 60 or 90-day invoices. It turns promises into immediate capital. And why does this actually matter to you? Well, because it keeps real goods flowing seamlessly to store shelves and stabilizes the prices we consumers pay every single day.
And finally, Section 5, RBI and monetary policy, the primary steering wheel. Sitting at the absolute apex of this entire organized structure is, of course, the Reserve Bank of India. And they don't just passively monitor the money market, they are its most vital player. The central bank actively uses this ecosystem to meet the short-term financial requirements of the government and, more importantly, to protect the long-term economic health of the nation.
Exactly. Think of the money market as the RBI's primary steering wheel. By turning this wheel, specifically by adjusting short-term interest rates and managing the total quantity of money circulating, the RBI sends these immediate ripples throughout the wider economy. If they need to curb inflation, they tighten liquidity right here. If they need to stimulate growth, they inject it. And this matters immensely because when the RBI turns this wheel, it eventually dictates the interest rates regular consumers see on their auto, home, and personal loans. It's the core mechanism for implementing national monetary policy.
It's just an incredibly intricate, beautifully balanced machine. But that brings us to the end of our explainer, and we want to leave you with a final, thought-provoking frontier. We know systems like NEFT and RTGS brought massive technological upgrades to this space. So how will emerging technologies like AI or blockchain further change the way short-term capital flows tomorrow? Will real-time digital settlements make this equilibrating mechanism completely instant? It really is a fascinating question for the future of India's financial system. Thanks so much for joining us for this explainer, and keep tracking those markets.